The issue of mortgage debt and its vulnerability to interest rate fluctuations in the UK has become a matter of great concern. With the goal of promoting home ownership in a property-owning democracy, there is a consensus among political parties that home ownership should be encouraged. However, the current situation places millions of households at risk of extreme financial hardship due to the exposure of mortgage debt to short-term interest rate movements. This lack of protection and care for mortgage borrowers can be considered a form of criminal neglect. Since the Russian tanks entered Ukraine in February last year and interest rates began to rise, a significant number of households in the UK have been forced to refix their mortgages at substantially higher rates. 2-year fixed-rate mortgages that were previously available at under 3% have now increased to close to 6%. By December of this year, it is estimated that a cumulative total of 4.4 million households will have experienced this hike in rates. The Resolution Foundation think tank predicts that as these 2-year fixes expire, mortgage holders' annual payments will increase by £15.8 billion. Considering that only a small percentage of households have savings exceeding £2,000, the Institute for Fiscal Studies forecasts that 2.9 million mortgage holders will completely exhaust their savings. The unique aspect of the British mortgage market is the significant interest rate risk that borrowers face on their own. This has led to a sharp decline in public trust in the Bank of England and its handling of inflation and interest rate policies. Governor Andrew Bailey acknowledged the mistakes made by the bank in a recent session with the House of Lords but focused on reviewing the bank's economic model rather than addressing the dynamics of the mortgage market itself. Given the current circumstances of the sharpest and fastest rise in interest rates since the 1980s, a review alone is insufficient. A comprehensive investigation is needed to examine the structure of British finance and find ways to make it fairer. Additionally, reforms within economic policy-making institutions are necessary. Both the Governor of the Bank of England and the Chancellor of the Exchequer, who nonchalantly suggests that a recession is worth considering to control inflation, seem unaware of the unique characteristics of the British mortgage market. Approximately 95% of mortgages in the UK are either variable or short-term fixed-rate mortgages, making the impact of rising rates more disastrous for household finances compared to other countries. While Lib Dem leader Ed Davey has proposed a £3 billion emergency mortgage protection fund, it only addresses the issue partially and fails to tackle the root problem. It is essential to prevent borrowers from facing a world where lenders can abruptly withdraw mortgages or reprice them, rendering them unaffordable overnight. To resolve this issue, the UK should draw inspiration from Franklin D. Roosevelt's New Deal and implement similar measures on a large scale. The US mortgage market, which used to be similar to the UK's, was reshaped by the New Deal. Public agencies were established to provide fixed-rate mortgages for up to 30 years or to backstop the system, ensuring that private mortgage providers could refinance existing mortgages or offer new ones on better terms. As a result, over 80% of American mortgages are fixed for extended periods, insulating the majority of borrowers from the impact of short-term interest rate increases. The UK should establish new public agencies with the capacity to refinance and guarantee up to £500 billion of mortgage debt, making long-term fixed-rate mortgages the new norm. The Bank of England's economic models fail to anticipate the current situation. Traditional economic forecasting assumes that economic agents are all-knowing, markets work perfectly, and banks and mortgage providers passively reflect market forces without exercising any agency. This flawed perspective not only leads to forecasting errors with significant consequences but also dismisses the idea that a British version of Fannie Mae or Freddie Mac could make a difference. If there is a demand for long-term fixed-rate mortgages, the market will supposedly provide them. However, it is essential for Andrew Bailey to go beyond conventional thinking and consider innovative approaches that would garner more public confidence. The current economic circumstances require imagination and a re-evaluation of the institutional framework. The lack of systematic coordination between fiscal policy, monetary policy, and climate change policy is problematic. The Treasury handles fiscal policy, while the Bank of England manages monetary policy, and the Climate Change Committee advises on achieving net zero. There is a need for mechanisms that integrate these aspects and align them with existing fiscal plans, national debt management, the unwinding of quantitative easing debt, and the refinancing of short-term mortgage debt. The current institutional structure, with its simplistic approach, is insufficient and needs to be reformed. To address these challenges, more than just an internal review of the bank's economic model is required. The UK needs comprehensive reform of the mortgage market structure and better coordination and management of fiscal, monetary, infrastructure, and climate change policies. The current situation of individual hardship and stagflation is unsustainable. Taking inspiration from Roosevelt's approach, a UK-style New Deal is necessary. While being fiscally cautious, a future Labour government would need to be innovative and creative to reinvigorate the economy and establish effective institutional frameworks that support long-term stability and fair access to mortgages.